Hello, welcome to European Open briefing for Monday, October the 8th. I'm Rafi Barajan, currency analyst at XM.com, and we're going to be having a look at what's happening in the currency markets today. So markets have started the week in a negative mood. We can see a big drop in Chinese stocks this morning. The CSI 300 closing down by over 4%, and the SSC Composite down by 3.7%. So Chinese markets have reopened after a week-long holiday, but they're only just catching up with the past week's event when we saw a further deterioration in US and Chinese relations. So the possibility of the two sides resolving their trade dispute in the near future is looking very much unlikely at the moment. At least we did get over the weekend action by the People's Bank of China, China's central bank. They cut the reserve requirement ratio, but that wasn't enough to halt a slide in equities across Asia, as well as the Chinese yuan, where the People's Bank of China set the lowest midpoint since last May. If you look at the dollar, it is edging upwards this morning. Dollar index climbing nearer the 96 level. The Japanese yen against Japanese yen, it's only marginally higher. The yen is also benefiting from that risk of sentiment this morning. If you look at European currencies, both the euro and the pound struggling against the US dollar. The pound giving up some of last week's gains made on the back of those reports that the EU is about to offer the UK a free trade deal, and that the two sides are nearer in reaching the withdrawal agreement. If you look at the euro, though, there are still concerns about Italy's budget. The EU has signaled that it will unlikely be approving the budget offer by Italy, where although they plan to raise the deficit for 2019, they will be aiming to reduce the budget deficit for the 2 years after that, but that doesn't seem to have been enough to appease the European Commission. We can see euro slipping back below the 1.15 level. If you look at the Australian and New Zealand dollars, both also slightly weaker against the US dollar. The loonie has also fallen sharply, despite the fact that on Friday we had very strong job numbers out of Canada. But this wasn't enough to offset a loss in the loonie. Perhaps weaker oil prices are weighing on the Canadian currency. We can see light crude, WTI light crude down by 1% this morning. So there are reports that Saudi Arabia may have already started to raise output in order to compensate for falling Iranian exports. But the main reason for the weaker oil prices this morning is the US has softened its stance a little bit on Iran, saying that it will allow some countries to reduce their imports of Iranian oil gradually and not force them to cut their purchases of Iranian exports suddenly in early November when those sanctions come into effect. Looking now at the main performance, we can see dollar CAD is the biggest gainer, followed by the dollar index. So a lot of weakness in other currencies against the US dollar, but oil is the worst performer, along with gold, which of course the strong US dollar is weighing on the precious metal. Looking now at the dollar yen pair, we can see the pair has been retreating from those 11 months highs touched last week. The dollar yen has been doesn't seem to have enough upside momentum to reclaim the 114 level, mainly because the yen is also seeing safe haven demand, despite the fact that the outlook for further US rate increases is increasing. We saw on Friday the jobless rate in the US fell to 49-year low of 3.7%, although the non-farm payrolls increase was somewhat less than expected. Nevertheless, everything else seems pretty solid in the US. We saw the 10-year Treasury yields climbing a fresh 7-year high of 3.248%. It's worth mentioning that it's partial holiday in the US with bond markets closed, so there are likely to be lighter liquidity once the US session gets underway today. But let's now take a closer look what's happening in China, because although the People's Bank of China did over the weekend cut its reserve requirement ratio for the fourth time this year to boost liquidity, we're still seeing a big sell-off in the Chinese currency as well as in Chinese equities. So there are concerns about the worsening trade dispute between the two countries, as this has now spread to other areas as well. There was a report last week that Chinese spies managed to insert a chip into US computers or being manufactured in China headed to the US, and there was also a near collision between US and Chinese military ships in the South China Sea. So the dispute is now turning into a diplomatic one as well, and that of course is weighing on the Australian dollar, which is as Australia is heavily dependent on exports to China. So we're seeing some concerns about how well China's economy will be able to withstand this worsening trade dispute with the US, especially if it if the US continues to pile pressure on China in different ways. For the time being, though, the Aussie is just about holding above last Friday's 32-month low of 0.7039. And let's quickly look at the Canadian dollar. So on Friday we saw a big jobs gain in Canada, but majority of the gains were in part-time jobs and not in full-time jobs. In fact, full-time jobs fell over the month in September. So this has raised some doubts about whether or not the Bank of Canada will be in a position to start raising rates more aggressively. Despite that, expectations are that the BOC will raise interest rates later this month. It's just that some investors were perhaps expecting even stronger economic data out of Canada. So we're seeing the loonie fall back very near to the 1.30 level to the US dollar. It's now the loonie has now given up all of its post-NAFTA deal gains made at start of last week. The rest of the day is going to be fairly quiet, with just the Eurozone Sentiment Index to watch out for. That's it from me. Thank you very much for watching and have a great day.